Bloomberg Audio Studios. Podcasts, radio, news.
The cocoa price rout continues, leaving African farmers worried.
This has never, ever happened in the history of this country. Why are we treating cocoa farmers this way? Why?
While weather conditions for cocoa farming looks good, the fall in prices could mean less income for farmers and prompt policy adjustments by regulators.
The farmer welfare is at the heart of every decision that the management takes.
On today's podcast, we'll look at the state of the cocoa market and how, after years of sky-high prices, the falling market is causing new problems for the world's largest cocoa-producing countries. I'm Jennifer Zabasajja, and this is the Next Africa podcast, bringing you one story each week from the continent, driving the future of global growth with the context only Bloomberg can provide. Joining me today is Bloomberg soft commodities reporter Mumbi Gitau. Mumbi, always great to have you back on the podcast. Thanks for joining us. So, Mumbi, when we have had you on the podcast before, we have talked about the sky-high cocoa prices. Fortunately, I've spoken to you since then, but here's how we ended that last discussion on the podcast.
The price is really dictated by both elements, supply and demand. So we'll continue to focus on how much production is coming out of Ivory Coast and Ghana and how much chocolate companies are able to still continue producing chocolate at these really high levels.
And so now, shockingly, we're seeing prices going in the complete opposite direction. Quite a roller coaster of volatility that we've been witnessing with cocoa. Talk us through what's happened from your vantage point.
You're right, Jen. It's been such a roller coaster. We've pretty much wiped out the rally of 2025 and 2024, and now we are back to the levels that we saw in 2023. I guess what they say about higher prices curing higher prices is true because we've seen a lot of demand destruction. What happened is that as chocolatiers passed on the higher cost, consumers started cutting back on their consumption of chocolate. At the same time, the manufacturers also cut back on their use of cocoa because they wanted to protect their bottom line, they wanted to protect their margin, so they've ended up using less cocoa in their products. I'm sure you've seen your chocolate bars have gotten smaller. Other manufacturers have opted to remove the chocolate in their branding, and now they're just saying it's chocolatey. All this is taking away demand from cocoa. That's industrial demand and consumer demand. And when you have higher prices, to bring back demand, you need to have lower prices. And that's what's causing the price correction that we are seeing in the market right now.
Yeah, chocolatey as a description is quite interesting for a consumer and also, I'm sure, for manufacturers to adjust to. But if we talk about what's happened with the climate, we've spoken to you about a few bad years of bad weather, but it seems like growing conditions have actually improved this year. Will that be enough to turn the tide for farmers and for them to be able to capitalize on this moment?
I mean, it's been a series of bad weather and now they are having good weather. That's good in the grand scheme of things, that they'll have a much better crop. However, when prices are falling this fast, it's hard for the farmers to capitalize. Production is not expected to recover that much. Just because we've had good weather doesn't take away from the diseases that are currently ravaging farms in West Africa. It doesn't take away from the lack of investments that has happened in the last few decades. So there are still structural issues that continue to affect farmers. Well, the weather is good right now, but some of the aspects that are more structural, like diseases and underinvestment, still remain. They might collect a decent crop, but if prices do not recover, if prices continue falling, then you don't get as much from the crop that you're harvesting.
Which is probably why we're seeing some of the West African producers resulting to new measures to adjust. Can you speak to what's been happening in Ghana and also top grower Ivory Coast as they adjust to the falling cocoa price?
Now, Ivory Coast and Ghana really find themselves in a very difficult place. When the market was rallying, we've spoken about this previously, they have a pricing mechanism in which they set farm gate prices, and those prices are locked in for maybe 6 months or 3 months. Now, when the prices were rallying, they could not immediately help farmers capitalize on those prices. Now, just when they had started raising farm gate prices, prices on the futures market have collapsed. Now, Ivory Coast and Ghana have farm gate prices that are above the market price in the world. how do you sustain prices that are well above what other regions are being paid for? That's what's put them in a really difficult place, because exporters are saying, how do we buy cocoa from you at $5,000 when the market outside is $3,000? It doesn't make sense for us. Those margins will really be squeezed. And now we've seen cocoa piling up in Ivory Coast. We've seen cocoa piling up in Ghana. And that's where now the regulators are going back to the drawing board and asking themselves difficult questions. Do we need to keep this pricing mechanism where we lock in prices months in advance without any insight on what happens to the market? They did not anticipate this correction in prices. No one anticipated that prices would fall this far, this fast. And now you need to reconcile what farmers are being paid and what the market price is in the world market.
And Mumbi, just hold that thought. I want to dig into that more. We're going to take a quick break. And when we come back, we'll look at what the long-term future for cocoa production could be like, especially when it comes to the farmers, as you just brought up. We'll be right back. Welcome back. Today, we're looking into cocoa and how West African production is adapting to cheaper market prices. Our soft commodities reporter, Mumbi Gitau, is still with us. So, Mumbi, just before the break, we were talking about the adjustments and the shifts that we're seeing Ghana and Ivory Coast talking about, considering the volatility in the market. When we talk about the farm gate price, were the farmers ever able to capitalize on some of the higher prices when they were at their peak?
Only regions where the markets are liberalized, like Cameroon, Nigeria, Brazil, Ecuador, were able to capture the high prices. Farmers in Ivory Coast and Ghana did not capture those high prices. Yes, the regulators raised prices in the last few months or in the last few seasons, but that has not completely translated to them capturing the whole rally. At some point last year, or in 2024, we had prices reach $12,000 a ton. The highest farm gate price that Ivory Coast and Ghana have gotten to is about $5,500 a ton. So there's still a lot that they were not able to capture when the market was really high.
Which is quite unfortunate, especially when you think about some of these contracts that were not able to be fulfilled for some of the farmers. Potentially, that's the reason why we're seeing some of the reaction. I mean, how do you interpret it, Mumbi?
It's such a loss for farmers in Ivory Coast and Ghana. They missed out when the prices were rallying, and now they're going to even suffer as prices are falling. As you've painted the picture, in Ivory Coast, farmers are sitting on cocoa that no one wants to buy. And as for reasons I explained earlier, why would an exporter pay much more in a market where you're not guaranteed to be receiving as much from your buyers? And I think now farmers are looking at a situation where they are stuck. They are left in a situation where they don't benefit regardless of whichever direction the market moves, whether in their favor or against their favor. They are still very stuck in a bad situation.
What do you make, Mumbi, of what the authorities have been saying about the latest prices?
You really sit and you feel for the authorities because they are stuck to a traditional model that worked for them when the market was not volatile. When the market barely moved $50 a day, now we have a market that's moving $500, $200 a day. So in a market where the market was more predictable, that model makes sense. Now it's becoming harder for them to defend this model in such volatile times. When you set a price in October, only for it to now be changed again in March, how do you stand by that position when between October and March, the futures market is moving wild? When we started the season, we were at 7,500. Right now, we are just in the middle of the season and we are at 3,000. Farm gate prices haven't moved an inch during that period, apart from Ghana, which recently cut its farm gate price. So when I look at the authorities, I just keep asking myself, how do you continue to defend a policy that is not working for you and for the farmers that you're there to protect?
Sure, and especially if this is a moment that they haven't been faced with before, right, Mumbi? Is this something, a once-in-a-generation shift that we're seeing? Will this potentially set the precedent for the future? Are soft commodities, as a soft commodity reporter, are you used to this type of volatility and the up and down? I mean, what do you think this moment maybe symbolizes, considering some of those characterizations you just mentioned?
I think for being in the market, we are very used to saying uncharted territories, unprecedented times. But these, for most veterans that I have spoken to, people that have been in the market for 40 years, say they have never seen anything like this. The volatility in the market is like anything they have ever seen, where the market is moving wild. So this has really introduced traders, regulators, farmers, manufacturers into a very new area that they don't have experience in. Everyone is just trying to learn as they go. And it's hard to say whether this will be the market for the foreseeable futures. I think demand is still a big question. Does industrial demand come back, that these prices are falling back? Do consumers come back and buy a lot more chocolate? Do regulators change the way they function? Ghana has said they will adjust domestic pricing depending on what happens in the futures market. Is that going to be the way forward? If we start to see these structural changes stick, then volatility is going to be the name of the game going forward.
And let's just finish then on demand. Will consumers see this in the short term? Will Mumbi go to the store and start to see falling prices? I mean, when does this hit the reality, the day-to-day for people and consumers who these manufacturers and producers really need to turn the tide?
That's the big question, but at least in the short term, it takes time. There's usually between a 6 months to 12 months lag effect. Just because prices are falling on the terminal market doesn't mean that prices for the consumers will fall immediately. We didn't see the same rise in chocolate prices when futures were rising, because right now manufacturers are still working through stockpiles that were bought at 6,000, 7,000 levels. No, we may not see short-term relief, but as we go towards the end of the year, we might see more promotions, we might see a bit more discount. But for now, we are just stuck with expensive chocolate until manufacturers start to input cheaper cocoa in their supplies.
Mumbi, thanks again. We always love having you on the podcast. That's Bloomberg soft commodities reporter, Mumbi Gitau. Here's some of the other stories we've been following across the region this week. Kenya's central bank still has room to cut its benchmark interest rate after lowering it 10 times in the past 1.5 years to help spur economic growth. That's according to Governor Kama Thugi. A stable currency, benign oil prices, and a forecast of abundant rains will help the central bank of East Africa's biggest economy maintain its accommodative policy. And Botswana's inflation will peak at just over 5% this year, down from a December forecast of 6.2% due to, quote, stabilizing exchange rate dynamics. That's according to the Bank of Botswana Governor Lesego Moseki. And you can follow these stories across Bloomberg, including the Next Africa newsletter. We'll, of course, put a link to that in the show notes. This program was produced by Adrian Bradley and Tiwa Adebayo. Don't forget to follow and review the show wherever you usually get your podcasts. But for now, I'm Jennifer Zabasajja. Thanks as always for listening.